Happy Friday. Brian Manning here, and lots of news this week talking about the Federal Reserve and also how global markets are affecting interest rates. So, earlier this week around Monday, we had Greece announcing that they are once again unable to satisfy their debt to the European Union. And certainly causing a lot of waves, and it feels like we've been talking about Greece and the international effect on mortgage rates for quite a while now. So first let's look at why would Greece join the Eurozone. And one reason is because there's a benefit in being part of the Euro, because when a country like Greece wants to trade with other countries, it makes it easier for them to go through the process of selling products to other countries when you're on the same currency. But once you're as part of the Euro and you have to contribute to the debts, if you can't make your payments on time, it really starts to become a big problem. And when you have a country like Greece that is potentially going to default on their debt, and we'll have to wait and see what happens, the problem is that there's an impact here that affects the other countries as well. And you have other weaker countries that are part of the Eurozone that are looking at this, and they certainly could open the door to other countries following suit of what Greece is doing, which would have a really negative impact on the Eurozone. So working something out of Greece is definitely in everyone's best interest, and we'll have to wait and see what happens. As a result of what's happening in Greece, this certainly has caused investors to flee to safety. And when investors flee to safety in the U.S. and on an international level, typically they invest in bonds in the U.S. markets and also in Germany. So as a result of this, we're starting to see a little bit of improvement of interest rates. Wednesday of this week was Fed Day. Wrapping up the two-day meeting, Janet Yellen does her press conference, and certainly a lot of volatility in the markets going into Fed Day. Fed's just very specific on the data they're looking at. They're considering inflation and a lot of different indicators on when they're going to hike rates. And, part of the volatility is making adjusted rate mortgages very appealing as well. If we look at the 5-year ARM, for example, right now, 5-year ARMs are pricing out about 1.25% lower than the 30-year fix. So when working with clients, starting to see some benefit in the adjusted rate mortgages because volatility in the financial markets is causing fixed rate mortgages to go up. Thursday was a big day because everyone was just kind of digesting what the Fed had to say and what's going to happen with the Fed. And it's like the Federal Reserve just keeps drawing this line in the sand. And in their recent press conference, the Federal Reserve says, hey, we see a rate hike in the near future, and what we anticipate doing is hiking rates when unemployment hits 5.1% and when inflation hits 2%. Well, if you think back to the days of Ben Bernanke not long ago when he was the Fed president, Bernanke said, hey, when unemployment hits 6.5%, we're going to raise rates. Well, here we are drawing the line in the sand again, coming down to 5.1%. So we'll have to wait and see what happens. But they did emphasize that they're very data dependent. We'll probably see a rate hike by the end of this year. Could be a one and done kind of thing. I don't know. We'll have to wait and see what happens. But interesting. On Thursday, we also got the CPI, which is the Consumer Price Index, and that measures inflation at the consumer level. And if you look at the core rates, that strips out the costs of food and energy. Right, the core rate of CPI for May of 2015, which replaces the statistics or the data from May of 2014, was up 0.1%. And that doesn't sound like a lot, but when month over month you have inflation increasing by 0.1% and 0.1%, that brings you up to their 2% threshold really quickly, and brings us to a closer rate hike. So right now, inflation at the core level, which is a huge indicator the Federal Reserve looks at, is at 1.7%. So very likely we'll see an interest rate increase in the future. Wouldn't be horrible. Inflation is the enemy of the bond markets, and inflation is also the enemy of interest rates, meaning as inflation increases, mortgage rates increase as well. So if the Federal Reserve raises rates, contrary to popular belief, we would actually probably see a benefit on the mortgage side, and you'd probably see mortgage rates go down a little bit as a result of the Fed kind of cooling off the inflation process that we're in right now. Today, no real major news coming out today. All eyes are on Greece. Emergency meeting taking place in the Eurozone on Monday, trying to figure out what they're going to do, if they're going to work it out there. So we'll have to wait and see what happens. I will be around all weekend. If you have any questions, any buyers who want to get pre-approved, please give me a call. Certainly would love to help you and would love to be part of your business. Happy Friday and have a great weekend.